All right, welcome back to another edition of Financial Accounting. We are here Friday, March 26th, and we're going to talk about 8.3 and most of 8.4. We'll finish up 8.4 and the rest of Chapter 8 on Monday. Sunday, I only have you have due is the 8.3 homework, so make sure you get that done on time. The other homeworks will be due on Tuesday. We'll have a review next Wednesday. A week from today, exam 4 we will have at 3 o'clock. So a week from today, 3 o'clock, we'll have exam number 4. People can steadily do better from exam 2. Exam 3 was better. Exam 4 will be a little better still. So, but again, it sort of just comes down to making sure that you're reading before you come to class, attending class, paying attention to the lectures, getting all the homework done, etc. Asking me questions if you need it. I'm happy to talk with you if you're struggling in this class. No problem. Come and see me. As a reminder, the extra credit project is going to be due on April 20th. That's in less than a month, so that's going to come up pretty fast. A lot of students tend to view that extra credit project as a way to really solidify this accounting knowledge. It's great prep, especially before the final exam. So make sure you get that done and let me know if you have any trouble with that. Let's jump into 8.3 and talk about what it is that is all about, notes payable. We've seen this before, but what's really new in 8.3? Well, not a whole lot of new concepts. You've seen a lot of these things before, but we just need to sort of solidify them and talk about things that may appear on the exam. So a note in general is just a written promise to pay money in the future plus interest. We know that because we saw that in chapter 5 when we looked at notes receivable with accounts receivable. Chapter 8 is talking about notes payable in this case. So we're on the side where we owe money in the future. We're not going to receive money, but the same calculations and concepts and tips still apply. We just need to be very careful about calculating interest and the amount of months that have gone by when we do those calculations. Short-term notes payable are those notes that are deliberately not more than 1 year long. Sometimes they're called bridge loans. You might see that term sort of float around, basically for organizations to help them with an acquisition. They may have the ability to pay for it, say, 6 months, 9 months in the future, but they need the cash right now. So they approach the bank and they say, I just need a short-term note payable to get in on this transaction right now. So oftentimes banks, my father was a banker for years, so he's very familiar with giving out bridge loans, usually to customers he's worked with for a while. So he knows that they're good for it. They just need like a temporary amount of money to borrow. So as an example, assume that we've got on January 1st, 2018, we, the company, purchased some goods. So in this case, it's not like we're borrowing money from the bank. We're just going to work directly with our supplier and say, hey, I need some merchandise, but I don't have the ability to pay you right now. I can pay you in 1 year. Can we set up a note payable arrangement? And if the supplier says, yeah, I can agree to that, here are the terms: $8,000 principal, 10% annual, i.e. stated interest rate. Now remember, when you're given rates on these problems, especially in the homework or the exams, these rates are over a 12-month period. So number one thing I always recommend is start drawing out a timeline. Just sort of kind of get the big picture in your mind as to what's going on. We are going to pay this person not now, not in 1 month or 3 months, but in 1 year. So if they agree to that, how much interest is going to be incurred over that period? It's going to be a lot of interest. That's a long time that this note's going to be outstanding. But also keep in mind this too. One thing that I think Chapter 8 doesn't really emphasize enough is the importance of our relationships with our banks, relationships with our customers, relationships with our suppliers. If I need merchandise now, and I know that I cannot pay for it right now, I have a ethical responsibility to tell my supplier that I cannot pay him. I don't want to say, oh yeah, I'll pay you next month, and I know I can't, because that's just going to piss him off, and he might not do business with me. So it's important to understand that this class is all about numbers, but numbers represent people. And so when we enter into a deal to acquire goods and we promise to pay that money back plus interest, we need to make good on that promise. Because if we don't, hey, we might not see any business from that supplier. If we depend on that supplier, that could kill our business. So when you get this information, realize that we've entered into a promise and that every month that goes by, we are incurring an interest expense charge. So I tend to, after I draw the timeline, calculate roughly what is the total amount of interest on an annual basis. The annual rate is 10%. If I multiply the annual rate times the principal, I would get an annual interest. This is how much interest I would incur over a 12-month period. Okay? Typically, what I do is then divide it by 12 months to get a monthly interest charge amount. However you do it, it's up to you. But I'm just sort of going back and providing these tips, these options of calculation. There's no real formulas here. It's just kind of conceptually, how would I go about figuring out the interest associated with this? So if I gave you this information, say on like an exam, and I said, hey, go through and tell me, hey, how much interest would be incurred over a 9-month period or a 6-month period or over the 12. Don't assume that the problem is just asking you to determine a 12-month interest charge. Be very careful when you're going through these problems. Okay? The number one reason people miss points on exam 4 is because they rushed through it too quickly. And they didn't pay close attention to the dates. So I don't want that to be you. So make sure that when you're going through this, you're doing the correct calculations. If I say 9-month, just multiply the monthly interest times 9 months, and boom, you get 600. Or you can just take the 800 annual, the total interest over 1 year, and just multiply it by the fraction of the year that it's outstanding. Fraction of the year being 9 months out of 12 months. So that would get you interest expense of 600. Same thing, but you have to choose a methodology to get you the right number, whatever makes sense to you. So on using this example, let's talk about the different transactions involved with this particular borrowing arrangement. I'm not really borrowing money. I'm just promising to pay back money for inventory that I get right now. So assume that we have a December 31st fiscal year end, and most problems you have to make that assumption unless they tell you otherwise. So here I'm just simply saying is it's a 12/31 year end. We buy the goods, we acquire the goods on January 1st. What's the transaction on that date? We're just going to debit inventory and then credit not accounts payable. We're crediting notes payable, and we probably designate it the short-term account. That goes in. It's not accounts payable. It's not a long-term note payable. It's a short-term. We're going to pay this off within 12 months. It's down below. I posted journal entries. Generally speaking, if I see the word note, I know there's some sort of interest component. So I've sort of set up as placeholders interest payable and interest expense off to the side here. What's the next potential transaction? Well, assuming that we don't make any accruals for interest, if we go 12 months to the fiscal year end, we got to stop and ask ourselves, is there something that we need to accrue for any interest expense, any type of expense that's been incurred? Here we realize that we have to make an adjusting journal entry for interest that's been incurred over the past 12 months. So in this case, interest expense is what we're going to record on the 2018 income statement at a rate of $66 per month times 12 months, or you just take the 800 and multiply it by 12 12s. I'm just sort of showing you the different options here. We know that 1 year has gone by, $800 of interest expense has been incurred. Yes, we pay it off the next day on January 1st, 2019, but for right now, we need to record how much interest expense has been incurred in 2018. And so that's why we're doing this. We're matching our expenses with our revenues. We haven't paid it, so we're going to use an interest payable account. Even if it's just for 1 day, we need to do that. Boom, we make the recording or post the journal entry into the ledger. This is the 2018 interest. Key thing to remember here is even though we pay it in 2019, it's an expense related to 2018 because that's when the note was outstanding. Key thing that people tend to make a mistake on is the payment journal entry. So don't miss this on the exam. If we're paying this thing off on January 1st, 2019, I know that I'm going to be paying cash. So I know that I just start sketching out the journal entry at this point. What is happening? It's going to be a cash payment. Usually what I do is I go into the T accounts to see, well, how much am I paying off? And down below, we have $800 of interest payable that I need to pay off, pay to the bank, or pay to my manufacturer in this case. I've got $8,000 of principal I need to pay off. So those two amounts are all that I need to get rid of. So those payables are going away. I'm paying off my note to the manufacturer. Manufacturer is happy. They got their money plus interest. And to the manufacturer, they would, they're not a bank, but they would show interest revenue on their income statement. And that just simply represents an other incidental revenue amount on their income statement that they earned from just waiting to collect on a receivable. On their books, it's a note receivable. Therefore, they have interest revenue. On our books, it's a note payable. We have interest expense. Just the other side of what we saw from chapter 5. Total amount, we paid out $8,800. So our inventory, we show on the books as $8,000. Practically speaking, it actually costs us a little bit more. Now, granted, in 2018, we show this $800 interest expense, right? Maybe perhaps we've already sold the interest or sold the inventory by that time too. I'm just sort of just showing for illustrative purposes. In general, it costs us $8,800 to get $8,000 worth of merchandise. Some economists and financial analysts think that the $800 of interest should be capitalized as part of interest. That's not necessarily the case. Only in certain situations would we actually capitalize the interest. Really what it comes down to is it's an interest charge the same way it would be if we just borrowed the money from a bank. So we keep these things separate just to say, hey, there was an interest expense that rose incidentally from buying this merchandise. So that's a pretty expensive proposition. And generally, you want to be in a position where you don't have to pay back interest for merchandise that you need to sell to customers. Alternatively, and again, this is where people tend to make a mistake on the exam, is assume that here we've got a 9/30 fiscal year end. Right off the bat, hopefully by now you realize there's a date thing I have to worry about, right? Well, in this case, it might become pretty obvious that I'm only going to accrue 9 months worth of interest because my fiscal year end requires an adjusting journal entry, how much interest is going to be for those 9 months. The journal entries are still the same. On the January 1st journal entry is still the same as what we saw in the previous example. I got inventory, I got a short-term note payable. Nothing new there. But it's so deceptive when you're going through an exam because you think you kind of know where the problem is headed. But if you don't read it carefully, you can make a mistake. It'll cost you points. So down below, we get to the fiscal year end, which in this case is 9/30, and we count the number of months that have gone by. What if you 1, 6, 7, 8, 9? 9 months at a rate of $66 a click means that in 2018, you've incurred $600 of interest. Why is it less? Because our fiscal year end just happened to be a little bit earlier than the previous example. Granted, this thing is going to be paid off 3 months later. So there will be another 3 months of interest expense we will record, but it will be in the next fiscal year. Right now, all we need to do is just record the expense incurred to date, which is just the $600 worth, or essentially 9 months worth. So down below, the interest payable in this case is just the $600. But this is as of 9/30. This is not December 31st. It's a different set of facts here. They look the same, but you just want to be careful with this. Now we go, you have to imagine, that was done. Now we're moving ahead 3 more months, and we make the payments. We pay off the loan, pay off the note payable, as of January 1st. What's the journal entry? It's a bit more complicated now. So, first and foremost, I'll just kind of spoiler alert this for you. We will still pay $8,800 total. Okay? The difference here is we've got first some expense to recognize. So I always recommend figuring out how much interest expense needs to be recorded just for those new 3 months that have gone by. We already did interest expense for those 9 months, we need to accrue interest expense that's been incurred to date, which means 3 months. So interest expense, 3 months times the $66, or just the 800 times 3/12, gets us to 200. Do that first. See if there's any interest expense that's new that needs to be recorded. Then just go down into the balance sheet and say, what are the amounts I'm paying off? I got interest payable, I got a note payable amount, I'm paying those off. Start filling those in. Total amount of debits in this case is 8,800. That's how much I'm paying off, 8,800. It's the same thing. This is for 2018. This is for 2019. This should be not 600. This should be 800. Well, note there, that should be 800 total of interest. I'm over the two income statements. 2018's income statement will show $600. 2019's income statement will show $200. Total amount of interest expense I'm recognizing over those two income statements is still 800, but it's just a matter of when the fiscal year end happens to arise. So total amount I'm paying $8,800, still $8,000 for inventory, and still $800 total for interest expense over a 2-year period. Current portion of long-term debt. Now, what we've talked about in the previous section was notes payable that are that's 1 year or less in duration. Those type of bridge loans, those happen, and those can be pretty useful if we have the ability to pay off those loans within 1 year. Some debt is entered into where there are installment payments, where the note is paid down little by little by little. So we could have, say, borrow, $10,000, not 18, borrow $10,000 from a bank, and then wait till, say, for 10 years. This is year 10. And then pay it all off in what's called a balloon payment. Just make a big, bulky payment at the end. That's somewhat risky. Banks prefer to set up arrangements with customers where they will be paying off little by little over time. So there's another option banks offer, which is an installment plan, where they can just pay off little by little over time, and say over 10 years, they make their final payment and they're done. The pay downs are also called installments. So an installment is essentially a portion of the principal that is payable within 1 year. So if we look ahead and we know that we're going to pay off, say, $1,000 of a note. So this is our 12/31/2018 period. And we're right at this point, and we're looking ahead. These are eyes. We're looking ahead over the next year to 12/31/2019. We're saying how much of our note, our $10,000 note, is going to be paid off or paid down within the next year. If we know that we're going to make an installment payment of $1,000, that means as of that point, there's $10,000 total in debt, but $1,000 of it is current, short term. It's going to be paid off within 1 year, and the remaining balance is long term or non-current. We need to make a reclassification of any amount of principal that is due within 1 year. So installment payments happen, and in fact, they're a lot more common than you think. So if you, for instance, buy a house and you enter into a mortgage loan with a bank, the mortgage loan is very unique to specifically individuals, not so much as businesses. And mortgage loans essentially require you to give monthly payments to the bank, and each month you are actually making an installment payment. It's a small amount in the beginning, but let's just say, every month you're making a mortgage payment of $1,000. Mortgage payments are broken down between what's called P&I, principal and interest payments. So your first mortgage payment might be something like where you're paying interest of like $980 of interest, but the other $20 is a principal payment or pay down. You are making a little bit of an installment. By the end, towards the end of a mortgage, especially like a 30-year mortgage, we're talking about 30-year mortgage, you're still making a $1,000 payment, but the amount of interest sort of shifts down to like $20 of interest, and the rest is like $980 in principal. That's how mortgages tend to work. You start off having a really high interest portion and a really small principal. And then over time, it does this, where this shifting point usually happens around the 20-year mark. So when you get to that point of a 30-year mortgage where you're paying off more principal than you are in interest, that's simply because the principal has been reduced over time. You have less principal outstanding, so the interest amount is going to be a smaller amount. The rest is all going to just paying off the principal. So the key thing about this is because you're making principal payments over time, by the time your 30-year mortgage is up, you won't have to pay a bulk payment to the bank. You've already paid off your loan. You just did it little by little in small micro installments every single month. So installment payments happen. And we just need to be aware of those things at the end of each fiscal year. We need to stop and ask ourselves, is there any portion of our long-term debt that needs to be reclassified as short-term? So a reclassification, make no mistake about it, a reclassification is just simply a balance sheet presentation. Our balance sheet, in a previous example, used to show current liabilities of $1,000 and long-term liabilities of $9,000. That's essentially just a reclassification of $1,000 from long-term to short-term. Do companies need to do a journal entry associated with this reclassification? Generally, no. This is just how they present the information. They can just have a note payable account and show the full $10,000 in there. The problem is, where they get in trouble is if they forget to do this reclassification on their balance sheet. Most companies I see actually set up in their accounting system 2 accounts, and you'll probably see this on your homework. A note payable short-term and a note payable long-term. And the reason why they set this up in their accounting system is because when they produce their balance sheet, usually it's just Control P for print. And the system will automatically pull in the balances and pop them into the balance sheet in the right places. So you don't have to manually move them around. So, and this makes sense because sometimes it's easy to forget. So if we had this note payable long-term account, we'd show the $10,000 in there at the start, and the short-term account wouldn't have anything. And as time goes by, if we know that we're going to pay off any portion of it, say $1,000, we'll just go ahead and remove that and put it into the short-term accounts. And then you got this $1,000 balance in this T account, a $9,000 balance in your long-term. That makes it nicer. So that way, these adjusting journal entries, when they happen, they're just for reclassification purposes. Most companies will do that just because it helps them keep all their things straight. It's difficult to keep track of all this stuff. So that's just one way of sort of doing a reclassification, is to use the journal entries, the ledger accounts, to reclassify those things. But here's the key thing to realize. The reclassification, however you do it, doesn't change the total liabilities. It just changes the composition of total liabilities. We've got more short-term debt than we do long-term. Okay? It may not really seem like a big deal, but it actually does make a difference. From a financial analysis perspective, a company that has more short-term debt, if you see a short-term debt increase, it's not really a good thing. And granted, I don't test you guys on ratio analyses as much as, say, like if I would by including Chapter 12 in this course. Chapter 12 does all financial ratio analyses. I don't test you on that information, but it's important to note, just to understand the importance of this reclassification, that a company's financial health is usually measured in a couple ways. And again, this I won't test you on the exam, but there's this concept called working capital. And working capital is a calculation where we subtract current liabilities from current assets. Generally speaking, if our total current assets are greater than our total current liabilities, that's a good thing. We would expect this to be a positive number. Okay? But if we have to reclassify any long-term debt into current liabilities, it's possible that maybe this goes to 0, or maybe it goes to like a negative amount. That is a sign of danger. And that, from a financial analysis perspective, can result in stock sell-offs, meaning that if the company has to pay off its current liabilities, it doesn't have enough in current assets to pay off the current liabilities. So this reclassification is not just a simple, oh, I just put some here and some there. It's like there's some negative repercussions that happens from that, but we have to make sure we do it correctly. And if we forget to do it, that has a stock price impact as well, because we really should be paying attention to that. There's also another ratio calculation, which I won't test you on, is the current ratio. So if you were doing, and for you finance majors, you'll see this over and over again. That's why I don't test it on this in this class. You finance majors, you'll see it again in your finance classes. Current ratios is taking current assets and dividing it by current liabilities. In general, we expect it to be greater than 1, meaning current assets are more than current liabilities. But if they're not, it's generally not a company you want to invest in. So I've only seen that. I've only seen when it's less than 1 or it's negative working capital. I only really see that for small startup companies because they're just trying to get going, and so they may have to incur a lot of debt. But it doesn't necessarily mean that they're going to go bankrupt. It just potentially is a signal that they're in trouble. 8.4 has some new concepts that we need to account for. But before I jump into them, I just want to sort of kind of recap this notion of accrued liabilities and expense recognition principle. Expenses need to be recognized in the period that they are incurred, which means that if we spent money to make money, we need to show those expenses in that period. We need to match those expenses against the revenues. We want to see how much it cost us to generate $1 of revenue. So that's why it's important we recognize expenses in the period in which they're incurred, because we spent that money in order to make that money. Okay. Most of our expenses tend to be paid after we've incurred them. So we have to accrue them, bring them on the books right now. So in the case of utilities expense, we use electricity, we receive a bill, then we pay the bill, right? Pretty typical. That means we need to accrue for those things, bring them on the books when we are actually consuming those resources. We don't just wait for a bill even. The bill comes at the end of the month, cool. But if it doesn't, we still need to make an accrual for an estimate, at least. So you've seen a lot of these things before. We get a bill, we accrue for it based on what the bill says. We owe $500. The next day, we pay cash of $500, right? No problem with those things. Those types of liabilities that we've seen thus far have some sort of catalyst, some sort of prompting that requires us to record a journal entry. We got a bill or we get an invoice. Those are fairly easy accrued liabilities to record because we have evidence of that. The problem, however, and this is what gets most businesses into hot water, are those accrued liabilities where we don't necessarily get a bill or an invoice. Some accrued liabilities require us to be proactive or at least aware of when they are actually incurred. We aren't always notified of these expenses, so we need to remind ourselves of these things. A good accounting system, when it's set up, will do these things for us, but if we don't have a strong knowledge about accounting, we don't really know how to set up those accounting systems, we can get into trouble. So think about it like this. There are certain liabilities that arise because they're associated with other transactions. And assuming we record those other transactions correctly, we need to ask ourselves, are there any type of other triggered transactions that are associated with that? So in the case where we sell inventory, we record cost of goods sold. We debit cash, credit sales revenue, then we debit the cost of goods sold for the perpetual system, credit inventory. That's a pain in the butt, right? 2 journal entries for 1 sale. But we may also have to accrue for sales taxes. If we forget this, we can get into big trouble. So, and mind you too, like I taught this up in Oregon, and nobody understood what sales taxes were because Oregon doesn't charge sales tax. But down here, you guys know what sales taxes are. So companies, they don't just record these 2 journal entries when they sell goods. They have to remember to also collect from the customer an additional cash amount which represents sales tax. If we forget to do that, we get in trouble with the state comptroller. They fine us and they still collect the cash anyway. So I worked with some local businesses here in town that have been busted by the state comptroller for failing to collect and remit the correct amount of sales tax. This is not something to mess around with. But again, unless we have an accounting system that automatically produces this calculation for us, we can easily forget that kind of information because we're not necessarily getting a notification for sales taxes. We need to be aware of that. Another type of situation involves employees' salaries expense. When employees work for us, they have to pay taxes, but companies also tend to have to match those taxes. So in the case of Social Security's tax in particular, companies have to match dollar for dollar what employees have to pay in Social Security tax. Companies have to match those, which makes it very expensive to own employees. It goes beyond just the salaries expense. There's matched tax that companies have to pay. It's really ridiculous. So the point of the matter is, we've got some liabilities that are pretty easy to accrue for. We get a bill, we record it. There's some accruing for one transaction might trigger the need for another transaction. And if we fail to be aware of this, we can get into big legal trouble. So that's why we want to be cognizant about what these things are. Sales tax, like I said before, we typically, as a business, and most businesses do this, we typically charge an amount above the retail price or the sales price, which represents sales tax. So in this case, assume that there's a 5% sales tax. Okay? In Texas, I think it's 8.25%. But if there's a 5% sales tax, when customers bring their goods up and we ring them up at the register, we need to make sure that it's not just the amount, the price that they are paid. We want to make sure that whatever the price is, we want to multiply it by 1.05, which the extra 5% being the amount of sales tax. So we will collect, if we make sales of 200,000, we will actually collect more than that. The 210 represents partly sales revenue, mostly sales revenue. The other portion represents a sales tax that we have responsibility for collecting, holding, and then remitting to the state comptroller. So we get $210,000 cash. Yay! We have to be very careful though. 10,000 of that represents a liability that we need to pay off to the state. A lot of companies, a lot of small business owners, they kind of look at their cash balance, like in this case, and say, oh, we're $210 richer. Let's go spend this or grow the business or whatever. And this is where a lot of businesses tend to fail. 10,000 of that is actually restricted. It needs to be sent to the state comptroller. It's not even cash that the company really has a claim to. The claim is by the state. So some companies, what I advise them to do is have at least two different cash accounts, a general cash account and a cash restricted account. And the cash restricted is where I would say put in, of the 210 that you got, I would tell them put in 200 into the general business account, because that it really is money you can play with, and put the other 10 in the restricted cash account, just so that way you don't touch it when you're making purchases or buying things in general. In this case, let's just assume that we're a smart company, and we know how to manage our cash well. It's best as quickly as possible, every 2 weeks or at least every month, to go through and pay off or remit to the state the amount of sales tax that's been collected and is owed to the state. So here, all I'm simply doing is getting rid of the sales tax payable with cash. So down below my T account, paying off the state. That liability goes to zero, and what am I left with? Ultimately, I'm left with the $200,000, which represents exactly what the sales revenue is. What's the problem with this? Well, like I said, people tend to maybe use the $10,000 to pay for things and then the state comes knocking at the door and they don't have the $10,000 in sales tax to pay them. So just got to be very mindful about that. Payroll related liabilities. We've seen in previous examples salary expense, credit salaries payable. It's actually a lot more complicated than that. Employee compensation in general is more than just salaries. There's salaries and there's wages. Salaries are paid on a monthly or based on some sort of yearly range. Wages are paid by the hour. Okay? Those things are established at the beginning of an employee's employment. Okay? And during the fiscal year, as an employee may be offered a commission to make sales. And if they're offered commission for bringing in business, those kind of commissions, those expenses happen during the year. So we have to keep track of those as those arise. And they're highly variable. And optionally, at the end of the year, we may offer a bonus. This is a reward for everyone doing well. So these compensation packages, they have to be managed and maintained throughout the year. It's not just a simple, oh, we just record this times the number of hours he's worked. There may be other things that make employee compensation jump up or down. One thing to keep in mind is that for service type organizations that don't sell any goods, any inventory, their major operating expense is their employee compensation. So I'm not sure if any of you have seen the show Mad Men. It's about an advertising agency. And what you got are basically a bunch of people who are paid to sell ideas. It's not that they're really selling any merchandise, they're just selling ideas. Here is how you can convince a customer to buy your products. So they have a bunch of clients, but what's their primary expense? Employees. All these employees, you got someone who comes up with the idea, someone who manages those idea generators. You got somebody who takes out clients to 3 martini lunches and just gets them hammered in order to bring in the business, whatever, right? Huge expenses, not related with products, but related with managing relationships with their clients. As opposed to retail and manufacturing companies, their primary expense that they have to focus on managing is their cost of goods sold. They have employees too, but their biggest expense is really just managing cost of goods sold. Either way, employee compensation is a big component of a company's income statement and their overall expenses. So what are the different liabilities that arise related to employee compensation? Well, the salary expense represents the gross amount that we pay our employees. And that's the amount that we show as a salary expense. But by law, if we have employees, we have to withhold from their paychecks certain amounts related to their taxes. Now, this is the thing you need to keep in mind. Employees earn what we show up as salary expense, but employees are responsible for remitting to the IRS taxes associated with their income and with their Social Security and Medicare. So in 1913, the Revenue Act was passed, required all working employees in the United States to pay Uncle Sam income tax. Thanks a lot. Then, as a way to get the U.S. government out of the Great Depression, FDR and Congress passed the Federal Insurance Contributions Act, also known as FICA, which requires individuals who earn money to pay into Social Security and Medicare. And generally speaking, I don't test you guys on the rates. I just usually give that information to you or just tell you what the FICA tax is. But the important thing is you need to realize that the employee is ultimately responsible for paying these amounts. Employee is ultimately responsible for paying these amounts. The company, the employer, will withhold these, do the calculations, and withhold these amounts from the paycheck and remit those amounts to the federal government as a courtesy. Okay, so don't complain when you look at your paycheck and say all these taxes. If you did not have your employer deduct or withhold those amounts from your paycheck, you, the employee, would have to make the calculations and send in quarterly payments to the Internal Revenue Service. You don't want that. That's something that contractors do. Contractors are generally paid their gross amount, and then they have to go to the H&R block and have their taxes calculated and remitted. The salary payable amount represents the net pay. This is a key thing to remember for the exam. The net pay is what you get. That's the salary payable that actually goes into the employee's hands, and that's what the employee actually will cash. So, how does that all play out in an example? Assume that employees have earned $10,000. That is how much work they've performed for us. That's the value of their services that we have consumed. So immediately the first thing I do when I'm doing a journal entry, and this is just something you want to practice writing out, on scratch paper for the sake of the exam, is what would the journal entry be to accrue for salary expense and the associated taxes? Well, the gross pay, 10,000, represents the true expense. They worked for us for $10,000 worth of service, but we're not paying them that. We're paying them an amount less than that. It's not that we're ripping them off. We're doing them a favor by withholding and remitting to the IRS taxes that they owe. Okay? Now, granted, the employee is still responsible. That's why they fill out a 1040 at tax time. I mean, it's almost April already, so you probably know this if you're working, that you have to fill out a tax return. Tell the IRS, here's how much money I've earned, here's how much I owe in taxes, here's the amount that's been already sent to you by my employer, here's how much left I owe you. Okay, so these are generally just estimates, but nevertheless, we have to do this as a company, withhold these for the sake of the employee and remit them to the IRS. We determine that 1,200 is related to their income tax, 765 is related to their FICA, so we go ahead and create a payable for each one of these, and we plug in the associated liabilities. There is the income tax, taxes payable, salaries payable. Now, again, total amount that they worked is 10,000. They're going to see in their bank account, if we direct deposit this amount, $8,000. They won't see these amounts because those need to go to the IRS. As a company, I need to be aware of these liabilities, because if I don't have the cash to actually pay these off, I'm in trouble, and so is the employee. The employee is going to get audited and potentially fined, and me as a company potentially get audited, fined, and probably sued by the employee for not having the cash to make those payments, right? Employee deserves $10,000 in total. We're just withholding these amounts for their sake. When these are all settled out, when they're paid out, I'm going to go ahead and, well, probably first, pay my employees their paycheck, their net pay. Again, this is net pay. They get paid that in cash. Fine. That's what you see on your paycheck, is the amount, the net amount you're given, and you cash to the bank. When taxes are remitted, we go ahead and reduce those liabilities as well. Those are not going to the employee. Those are going directly, skipping the employee and going directly to the federal government. So if this is us, the company, and this is the employee, right? They're getting the $8,000, and we're skipping them and saying, yeah, I'm just going to go ahead and give to the U.S. federal government the other $2,000 that you will owe them. If we did not have them as employees, the company would just give them $10,000. Employee would have to, on their own, calculate and remit to the federal government their own $2,000. So it's a courtesy, right? But it creates a fiduciary responsibility on us, an imposition on us, to make sure we have that cash and that we remit the correct amount to the federal government. So total cash paid out. Get rid of the pay to the federal government. This is the U.S. government. This is the U.S. government. This is the employee, shorthand for employee. Total amount of cash I'm paying out is $10,000, equals the total amount of salary expense, as it always has been, as it always should be. Total amount of cash I'm paying out, that's the true cost of my employees. I'm just remitting things in certain directions for the sake of my employee. One thing I want to, and I'll stop right there, but one thing I want to also bring up is the fact that the cost of employees is even greater than what we see here. In this example, the amount of FICA was, let's see here, amount of FICA was 765. Okay, that was on behalf of the employee. The employee owes that amount to the government. We're just remitting it for their sake. Here's the problem though. If you're a company, by law, and this is going to suck when I say this, but I'm just letting you know right now, you have to match dollar for dollar what the employee is responsible for paying to the IRS in FICA. In other words, the employee is going to be paying 765 and the company is going to be paying 765. It's just by law. So you got the company, you got the employee. Essentially what it looks like is, hey, I'm an employee. I have to pay out 765 to the federal government, to Uncle Sam, right? The company sees this, and as a result, they are also assessed another 765. It's very expensive to have employees. And granted, the headache of just doing the withholdings, right, alone, that's lots of reason why Microsoft did not for years actually have employees. They had contractors. When you have contractors, the employee will pay the 765 to the US government, but because they're not employees, the company doesn't have to remit anything. And for years, Microsoft got away with that. But then the federal government became aware of that and came back to them and said, look, these contract workers their contracts are automatically renewed at the end of every year. So they're practically employees. So Microsoft was assessed a penalty and they had to recuperate by sending the federal government back taxes for what they should have been paying. Were the contract workers actually employees? Employees were the contractors were ones going out to H&R Block and saying, I am a contractor, I have to pay this much to the government, help me figure out how much to cut a check for. But Microsoft didn't have to worry about that. They didn't do any of the calculations. They didn't have to pay any of the FICA, additional FICA taxes. So that's an expensive thing to have employees.